Hello, this is Kevin Prince from BMO Exchange Traded Funds. Welcome back to the weekly Market Insights webinar. We had a little bit of break there and glad to have you all back and join us one more time. You know, this is something we started at the beginning of this crisis, and we're so pleased to have you back in again and again. And as we continue the focus in providing you insights to the overall marketplace. This week, we're going to have the Nasdaq. I'm going to do an introduction in a section, but I'm really pleased to have them on board because there's certainly lots of questions going on in that space. And I will highlight that all the content comes for these sessions based upon the questions that you send in to us on a regular basis. And that questions are so key, and we're going to answer some later on, but that also helps us drive our content on a regular basis. So thank you for those of you out there that have taken the time to send us those questions, because it has not only helped us put some questions in today, but help us drive the content on a go-forward basis, and that's why we have the Nasdaq join us today. So with that, let's get into it. Of course, just like in the previous sessions, we always highlight that this is market insights. We're not giving you specific advice in these sessions, and the same thing I'll highlight on Nasdaq's behalf. It's not specific recommendations either. What we're really trying to give you, again, is one more time, is insights to the overall marketplace. So let me introduce our guests here today. First of all, welcome back, Mackenzie Box. Thank you for actually hosting last week too, for that matter. So glad to have you back. And from the Nasdaq, we have Mark Marks coming in from the Nasdaq. So Mark, thanks for joining us. And I understand you're joining us for the next 2 weeks, this week and for next week, as we have our second show on the Nasdaq next week too, and having to join us. So thank you for joining us. Now, just getting a little bit into the context here too. You know, not only do we, listen to your feedback about having the Nasdaq on this webinar, certainly did that, but also, it's been a very topical week to have the Nasdaq around too. So we're certainly seeing the announcements in on SoftBank and the drive and the growth there, but also some volatility kick in too, and really starting to get a better understanding what the Nasdaq is from an index perspective and how that can really complement your portfolio. And that's kind of our goal today with this session. So before we actually go into the Nasdaq and understand the index and the history we're going to get from Mark in a second, what I usually like to do is start off with some insights and some tools from the index providers. So Mark, I understand you've got a bunch of tools on your website. We're going to talk about some more about next week. But for this week, let's highlight some of the stuff you have more related to more around the current crisis and what you have in that space.
Yeah, sure. Thank you, Kevin. I mean, we've certainly built out our broadcast capabilities in the new work from home environment here at Nasdaq over the last 6 months. The index team in particular does a bi-weekly trade talks where we talk about either the Nasdaq 100, usually on a Friday, or another index to highlight on Tuesday afternoons. Beyond the index team, our marketing department is constantly interviewing, experts in not just the investment and finance fields, but also folks with real subject matter expertise, including across biotech firms and research firms in the healthcare space. And so, yeah, we've been trying to get a lot of good COVID-related content that's on our website in general, and also in the index research section within.
Oh, perfect. And thanks for doing that. And thanks for highlighting the website. I'm going to encourage everybody to take a look at the Nasdaq's website itself, the news and insights specific section, because, there's some good, interesting articles up on there. This one specifically in regard to coronavirus. And next week, we'll take some time and effort and talk about some of the other tools they have around actually the construction of the index. So let's get into it a little more detail here. I'm going to bring Mackenzie in to kind of kick off the conversation around that, because I think the first thing to get some context, because this is an ETF focused webinar session, Mackenzie, why use ETFs to get access to things like the Nasdaq, and how does it provide efficient exposures is the slide comments here.
Thanks, Kevin, and thank you everyone for joining us today. And I think when we think about the Nasdaq and some of these other particular big names that we see within the index, ETFs are really appealing because of their easy to access, cost efficient, and instant diversification. They really allow you to get access to these, big tech names in a single solution, which with all other things would be quite costly. And just looking at the example here with Amazon, I think this really kind of proves how effective ETFs can really be. So Amazon is right now trading at $3,200 per share. And then meaning a board lot would cost you close to $320,000 for 100 shares of Amazon, which would be pretty far out of reach for most people. So with an ETF, you actually get access to these stocks in an effective way, especially from a cost standpoint, but you also get that broader diversification. So you're getting a basket of securities. And that way you're not putting all your eggs into one basket, especially at such a high cost. And I think the other thing I just want to highlight here too is, when you think about some of the securities in the Nasdaq, some of the more, growthier names right now in the news, we're seeing a lot of media pickup and people are very, interested in particular stocks. So I would just encourage you to visit our website. And if there is a particular stock that you are looking for exposure to, you can simply use our ETF tool and search for ETFs that hold a particular stock, whether it be Amazon or a particular other stock that you're interested in.
Thanks for that, Mackenzie. Let's start talking a little bit more detail around the actual Nasdaq, because it certainly isn't efficient to use ETF to access the holdings within the Nasdaq and get that diversified exposure. Mark, with you, let's kick off and have a little bit about the introduction of the Nasdaq and the overall theme of this index, maybe relative to other indexes out there. Can you give us that background?
Yeah, totally. Thank you, Kevin. At Nasdaq, we take a lot of pride in the fact that our flagship index is really a function of companies that list with Nasdaq, right? It's kind of unique in that sense that if you're not listed with the Nasdaq Stock Exchange, you don't make it into this index. You don't make it into a bunch of other indexes that we also maintain internally. But that is not in any way, shape, or form to be interpreted as some sort of drawback. Again, our listings business has done a tremendous job over the last couple decades, really selling the message to companies in the U.S. and globally, more and more globally as well, that NASDAQ is the home of innovators. There's a lot of different ways to describe them. You could call them disruptors, you could call them game changers, you could call them forward thinkers. However you prefer to think of them, at the end of the day, these are companies that influence our lives every single day. From companies like Intel and Microsoft, which have been around for 40 or 50 years and were pioneers in things like semiconductors and computer software, to now companies like Amazon and Google and Facebook and Apple, which are really, I would say, like the new era of large cap global companies that are driving innovation. And we're going to talk about how their business lines and a lot of the other companies in this index are not just purely focused around technology as a sector, and also just how much their efforts in terms of R&D are yielding benefits for them and as a consequence for any investors into the index.
Now that's insightful to think about game changers, and I think that's I like that perspective. Now you did a neat little chart here talking about bear with my click to it, talking about R&D. Give us some background on this chart and how to understand it, and really kind of a good proof point to it.
Yeah, sure. So the background here is, we have this partner, this strategic product partner called they're a kind of new age, big data, machine learning and artificial intelligence data shop that helps us create a lot of different thematic tech indexes, things that are specific to technologies like AI or autonomous driving or fintech or healthcare. But so, we have this massive data set from them. Essentially, they track patent activity both in the U.S. and globally on a real-time basis, and they map it out to every firm in the world. And when we look at, our equity universe, where we track something like 9,000 equities globally, and we say, okay, out of that universe of all publicly listed companies globally that we track, what percentage of patent activity do Nasdaq 100 companies actually contribute to? We can map it out this way and actually show it to you visually and say, look, for 3D graphics, for example, in the last 12 months, there were 26 companies in the Nasdaq 100 that filed at least one patent relating to that technology. And that activity in aggregate represented 49% of all patents filed globally in this technology among, publicly listed companies that we track. So this kind of shows you, it's a huge tail of what we've identified with our product partner as 35 technologies that are disrupting the economy and are vital to sort of what innovations are happening tomorrow. You can see that on average across 35 of them, the Nasdaq 100 is contributing 15% of all patent activity globally. So it's really, really more than just we have fancy products that people like. It's these companies taking, their earnings and reinvesting it in R&D continuously to drive innovations on a day-to-day basis.
No, I really like the chart, and really good proof point showing that the companies within inside the Nasdaq are the ones that are innovative out there, and certainly is showing that it is a leader's approach to the marketplace. Now, give us a little background on the overall history itself, because we all talk about the Nasdaq 100, which certainly been a conversation over a number of decades, but give us a little bit of a background around it itself.
Yeah, so again, it's an index that is comprised solely of companies that list on our exchange, and a long time ago, we made the determination that we were going to exclude financial companies from the index entirely. There are quite a few smaller financial companies listed on the Nasdaq exchange and part of the Nasdaq composite, but we try to exclude them at least for this index. It's been around for close to 35 years now. We did a special rebalance in the late 90s to modified market cap weighting, which we'll get into in a second in terms of how that specifically works. And then we also did a special rebalance in May of 2011. Every now and then we'll do these special rebalances when conditions in the market warrant. But otherwise, the methodology is very consistent, very predictable. Unlike the S&P 500 or the Dow Jones, for example, there's no index committee picking and choosing which companies get included in the index. If you're in the top 100 largest market caps and you're a non-financial company listed on the Nasdaq 100, you're in the index.
That's pretty straightforward. Hey, that special rebalance, I remember, because I was in the industry at that time. I'm dating myself, but that was actually a rebalance with a little bit of focus on Apple and trimming Apple in the index itself. Maybe Mackenzie, give me a little bit of background. What's the impact that rebalance had towards Apple itself? Because we're seeing the same thing going on with the Dow Jones these days.
Yeah, and I think on the next slide, Kevin.
I'm going there.
This better illustrates it. So, yes, in May 2011, when when Apple fell out, there was an immediate shock on the stock price in May, but by June it had fully recovered, and then by July it was actually back up roughly 14%. So I think really when you look over time, what that really says is when these rebalances happen, it doesn't necessarily have that long-term impact. Yes, you're going to kind of hear that short-term noise, and there's going to be the media pickup, and certain stocks are going to be impacted in the short term. But over the long term, being part of the index, it kind of allows it to work itself out. And I think we've seen a lot of other companies in the news recently, like Tesla, not getting included in the S&P 500. You see the immediate shock, following and how the stock is impacted. But I think over the long term, as we can see based on the graphic here, the index, it kind of just looks like little blips and onwards and upwards from there.
Well said. Well said. Advancing here. Button. So then, keep on that same context. You mentioned the S&P 500. There is a different, methodology, of course, behind that. You both talked about that. Maybe Mackenzie, just get a little bit of a taste here of some of the differences across the board.
Yeah, and I think when you look at allocating to like your broad markets and whatnot, people think of the big indexes and the Nasdaq and the S&P 500. So what I did here was I just grabbed two of our ETFs in Canada, ZNQ representing the Nasdaq and ZSP representing the S&P 500, and just did a quick compare of the top 10 holdings. Like Mark had said, the Nasdaq is those largest 100 names, obviously excluding financials. So you are getting a lot of the more growthier names, like he had mentioned previously, whereas the S&P 500, you're getting that broader diversification and full market exposure. But it is interesting because you do see overlap. However, when you actually look at the differences in holdings, Apple, for example, 6% differential. Nasdaq, you're seeing Tesla included, whereas in the S&P 500, it's not. So just looking as a comparison, there are differences, both big indexes, but just when you are looking, towards your portfolio, Nasdaq, so you're getting that more, obviously the tech and more growthier names from there.
Oh, that's insightful. And let's just keep going a little bit here, because I want to spend some time actually looking at more detail in the actual NASDAQ now as we dive in there. Mark, going back to you, I mean, we're using some terminology, modified market cap and that aspect. I always like to say it's basically largest company, largest weight is how we effectively talk about market cap. But when you say modification, what do you mean by a modified market cap? Like, what's the modifications that the index brings into the largest company, largest weight?
Yeah, sure. So typically when we talk about modified market cap weighting, we talk about a capping scheme. And, that was part of the reason that there was that special rebalance for Apple was because it was simply too big. It was too big of a component for the index under the rules. So, what I've tried to kind of summarize here on the right, on a quarterly basis, when we do a regular kind of quarterly rebalance, we look to see if any constituent is more than 24% of the index weight, we cap it at 20%. If the aggregate weight of individual components that are each above 4.5%, if that aggregate weight exceeds 48, then that group itself is capped at 40. And then on an annual basis, annually is when the index is reconstituted. So that's when we actually determine, okay, what are the 100 for the next year supposed to look like? We do another round of adjustments and we say, okay, if anything is over 15% on an individual basis, cap it at 14. If aggregate of the top 5 exceeds 40%, cap it at 38.5. And then everything else is capped at 4.4 unless your number 5 is less than 4.4, then that becomes the effective cap. These are just kind of a series of rules to design to make sure that the index doesn't become overly concentrated in any one or the top 5 holdings. So that's what we mean when we talk about modified market cap weighting.
Oh, perfect. I mean, it's good to get a good context there, and it's actually good to see other rules posted in one place, and appreciate that. Then
Sure.
Here, you did a quick little analysis there, Mark, and you kind of brought in, the differences between the NASDAQ and the S&P 500 when you talk about, the market cap itself and the average, medium, and min. And I think it's another way of looking at the two different indexes out there. Can you talk to us about this a little bit more?
Yeah, sure. I mean, look, we're always trying to get the message out here at Nasdaq that the S&P 500, even though it's a great index, it's more and more, I think, becoming supplanted in people's minds as the most important index to pay attention to in the U.S. I mean, you can see, when both of these charts start right at the end of 2007. the average, the median, the min market cap of a Nasdaq 100 company was considerably lower than for that of the S&P 500. And today, it's gone from being lower to being, twice as high in terms of, in terms of the average. In terms of, the median, it's close to twice as high. In terms of the smallest company, it's a little bit more than 2x. This is really just reflective of the tremendous growth that companies in the tech and also to some extent consumer and healthcare sectors that make up the majority of the Nasdaq 100, their growth over the last decade has been exponential, whereas the growth of the previous generation's kind of leaders in market cap, you think about the big energy companies, ExxonMobil, you think about the big banks like Bank of America and Citigroup, their market caps have gone down. So it's a very, very different story in terms of what you're getting when you're looking between the two indexes. More and more, the Nasdaq is representing the true sort of large cap exposure in the U.S. And fun stat to know is that within the S&P 500, I think on average we see 85 of the 100 Nasdaq 100 companies as part of that index as well. So it's not like there isn't a lot of overlap. There is. But it's the fact that those other 415 in the S&P 500 are so dramatically different from a sector and performance perspective that you really have to think, twice about, well, okay, which one do I actually want to be in if I want to invest in U.S. large cap as a theme?
Certainly interesting to see the changing over time, right? That is a dramatic change over time. In fact, actually, you've got a little bit about history here too when it comes to the Nasdaq over the last 10 years and how it's actually evolved over time too. Bring us up to speed of this chart too, if you can.
Yeah, so this is one of our favorites here to really hammer home the sector story. So using our own benchmark of large and mid cap companies in the U.S. So, anything that's considered large or mid cap, it's several thousand companies. We look at the actual sales growth, right? How much have companies in each sector grown their revenues over the entire decade, right? From end of 2009 to end of 2019, 10 full years of growth. Technology, healthcare, right? Almost doubling their revenues over that decade. Consumer services and consumer goods also growing at a healthy clip, right? The ones that are not growing, utilities, energy, basic materials. Now you look on the right-hand side and you look at the weightings differential between the two indexes. Nasdaq's got twice the exposure to technology. It's got more exposure to consumer services. It's got, way, way, way less exposure basically in the whole rest of the tail than the S&P 500. And that really kind of gives you the story of where the economy, not just in the U.S., but globally is also moving, because so many of these firms are global in terms of their revenue footprint. It's really been concentrated in a handful of sectors, right? The old economy sectors are going away slowly but surely, and that's a big reason why the Nasdaq 100 has outperformed so much over the last decade.
It's a very interesting slide. Thank you for sharing it, and thank you for putting it together. I mean, it does highlight one more time the leadership focus of the companies inside the Nasdaq. Now, you also have this chart here that kind of takes your top constituents and what they make up of the overall Nasdaq. I mean, that's a key part of portfolio construction, which we're going to spend some time on next week with Nasdaq again. We talk about, how Nasdaq could be part of a portfolio, complement or a core kind of aspect. But Mark, before we go to that next week, let's talk a little bit about those top constituents this week.
Yeah, so I mean, this is a slide that I just put together for the first time because I was interested in seeing really the concentration among the top 10 these days. There used to be some older school consumer and telecom names in the top 10, like Comcast, like Pepsi. What's happened this year with the coronavirus pandemic and with people realizing that tech is really the most ideally positioned sector for the current macroeconomic environment is that the top 10 in the Nasdaq 100 now are pretty much all tech companies, right? We operate in something called the ICB sector classification universe. which is a FTSE Russell way of determining sectors. And technically, 6 of these 10 companies are classified as tech. 2 are consumer services, that's Amazon and Netflix. PayPal is classified as an industrials. Don't really understand that one. Tesla's classified as consumer goods. At the end of the day, like, these are all tech companies. It doesn't matter whether they have a consumer customer base primarily, or enterprise, or mixed. They are, for all intents and purposes, technology, and not just technology as a single focus, but increasingly becoming diversified technology. You think about the leaders in the 20th century in the U.S., companies like GE and Berkshire Hathaway that were the largest companies in the world for the longest time because they had a conglomerate structure. They had their fingers in all these different diversified businesses, and sometimes that kind of mixture doesn't make sense, right? What we've seen with these tech companies is that they start out growing like Microsoft with a sort of core tech offering, or Google, right? And then they end up using their technological sort of expertise in terms of R&D and start expanding into more and more areas that touch consumer and touch healthcare, and touch any sort of sphere really that is innovative. So that's the point of the slide, is to show you, the top 10 really this year finally have become sort of what you would consider to be classic pure tech companies, and many of them are diversifying into multiple areas as well.
Yeah, good point on the diversification, right? You're absolutely right. I mean, Microsoft being a great one, of course, Apple too, with all its avenues of aspect across the marketplace. Now, quickly on this one then too, because we're going to again spend some more time about portfolio construction next week. This has really kind of highlighted how the fundamentals of the Nasdaq have changed over time. Give us a little background on that.
Yeah, so the way to read this chart, again, one of our favorites to show people is this is a per share rebased to 100 starting in 2003. So what were the per share earnings of the Nasdaq 100 versus the S&P 500, and what's been the compound growth since then? So in that time frame of 17 years, the per share earnings of the Nasdaq 100 index have grown by a factor of 22. In the S&P 500 by a factor of only 4. Revenues have grown by 6.5 versus only 2x in the S&P. Dividends, right? Tech companies, you were dealing with mostly, high growth new companies. More and more, they're becoming mature. Again, they're becoming diversified and getting those stable revenue streams. They're growing their dividends like crazy. So even though the overall yield of the index is still below that of the S&P 500, it's catching up, and it's catching up quickly. And that fundamental story, again, reinforces the performance story.
And of course, the leadership of the companies with insight there.
Yep.
Thanks, Mark, for that. Mackenzie, let's talk a little bit, before we get into questions, let's talk a little bit about how to access the Nasdaq. There's a number of ways to do it. So let's make sure that people are aware of that out there in the marketplace. Maybe you can walk us through this slide.
Yeah, and just kind of tying off from my first slide about ETFs being an efficient access vehicle to access the Nasdaq. There are quite a few options for investors. So obviously BMO has 2 great options. We have a hedged and unhedged. I would highlight that we were the first Canadian ETF to launch with the Nasdaq. And then iShares also has a hedge to CAD solution, XQQQ, sorry. And then the big one in the States, which is QQQ. However, that one is domiciled in the US. So there are some things you need to be cognizant of when looking across the board. So obviously, fees are a big consideration, looking at the AUM. But then particular, if you look to the US one, your currency conversion costs, as well as your T1135 and US estate taxes. So there's definitely options out there, depending on what best suits your portfolio. But just want to be mindful of a few things as you're looking, if you look to add these to your portfolios.
Thanks for that, Mackenzie. And exactly right. We're going to spend some more time with the Nasdaq next week, and talk about portfolio construction and really take the insights that Mark has provided today, as well as Mackenzie, and bring those together to talk about portfolio construction as we layer in that kind of bigger concept itself about how to apply the Nasdaq within inside a portfolio. So with that, let's shift gears and let's go through some of the questions that came in this last week. So first and foremost, there's a lot of volatility in tech sectors, very topical, of course. Most notably, Tesla, that was a drop at the time, 21%. It probably picked up a bit. When rebalancing an ETF, funds like the Nasdaq, of course, like how do you protect investors from getting hit hard by companies like this? And I'm going to ask both Mark and Mackenzie to kind of dial into this one. First, maybe let me bring in Mackenzie to bring in on this one.
Yeah, thanks, Kevin. And I think, this kind of just goes back to the benefits of an ETF because it's, providing that diversification. You're not just fully exposed to one single security. You have, a broad set of securities. So, even though a single stock has gone down, you're diversified across the board. And then, that impact is only minimal when you're looking at a larger set of securities. So, one of the benefits of buying an ETF through that kind of solution. So, yeah, I think that just brings back to the benefits of an ETF. And when you look at these broad market indexes, you're always going to kind of see those natural winners and laggers in the marketplace. And I think when you look to market capitalization solutions, you will see securities kind of rise to the top or rise to the bottom. But being in a diversified mix, you kind of are able to ride that out a little bit better.
Thanks for that. And Mark, just coming back to you, you have limitations there too, from a position getting too large that might really impact an investor. And I think you highlighted that before. Maybe just quickly remind people about that.
Yeah, I mean, again, it all comes back to index construction, right? And it would be very, our lives would be much simpler if we just said, well, everything's going to be purely market cap weighted. And if Apple becomes, half the size of the index, then who cares, right? We just leave it alone. That's not what we do. The modified market cap weighting, again, is built there, is built to make sure that, at least on a quarterly basis, we're revisiting individual and top 5 weight concentrations and applying some more reasonable caps to prevent, something like a Tesla dropping 21% in a day. If it were to become, the largest stock in the index, there's built-in caps on that. It's going to limit how much any one particular stock can drag down the index on its own.
And keeps that diversification in place at all one time.
Yep.
Here's another question that came in today too, is in regards towards ZPay. And in this question, what they're effectively looking at is the holdings listed in our public website being 64% in UST bills. And, and talk about a little bit of cost too, but really, I think what I want to do here is, this is a good question. We're going to actually build a webinar in the future on this one, because what we want to do is highlight that you need to look underneath the hood and primarily look at exposures when you're looking at different ETFs. So not just the holdings, but the exposures. And you think about ZPay itself, it is a derivative-based structure. And so the T-bills, for that matter, for the most part, are offsetting the derivative exposures we have, both the puts and the calls within inside that. So ultimately, what I want to highlight here is when you're looking at any ETF out there in general, don't just look at the holdings itself, but start to factor in the exposures that those ETFs have. And we will actually dedicate a session to this to really help everybody get insights about how to look for those exposures going forward and what I really mean by that when I say exposures relative to holdings. Now, a couple more questions. Of course, the Nasdaq is one of the most followed indexes out there. We did already talk about the weightings. Question for you, Mark, here is regards towards the correlation. Can you give us some insights on the correlations of, let's say, the Nasdaq relative to the S&P, and if you have it on the Dow Jones too?
Yeah, sure. So, relative to the S&P, the correlations are actually quite high. Again, I mean, I mentioned that the overlap is quite solid in terms of 85 of the Nasdaq 100, usually around there, end up being part of the S&P as well. So, when I look at it on a calendar basis, it's usually at least around 0.9 to 0.95. That's what it's been this year. Sometimes a little bit lower. I mean, there are shorter periods of time when the indexes will diverge a bit. And as far as the Dow Jones, that's kind of, at least in my mind, the indicator of whether divergence is actually happening. We saw this year the correlation between the Dow Jones and the Nasdaq 100 fall to even below 50, to below 0.5 over a 6-month or even over a rolling 12-month basis. And, again, the Dow Jones, it's a very antiquated methodology where, it's not only price weighted as opposed to market cap weighted, but it's selected by an index committee. It's much less diversified with only 30 names, and tends to overweight, again, to those old economy sectors of financials and kind of classic industrials like GE, like Boeing. So not a surprise, given the unique macroeconomic backdrop this year, with a lot of those older economy names getting hit really hard and tech going in the opposite direction. Not surprised to see those correlations really weaken this year.
Good insight. Appreciate that. Let me close off our question here today with Mackenzie. Maybe it almost looks like a planted question, to be honest with you, but what's the best way to purchase the Nasdaq ETF from a hedged currency out there? And do we offer a product like this? Does BMO offer a product like this?
So yeah, I would just bring that back to my last slide. We do have two products. So we have the hedged version and the unhedged version, ZQQ and ZNQ respectively. So yes, I would encourage you to explore our website. Has all the information there if you want to learn more too.
Thanks for that, Mackenzie. And also thank you, Mark, for joining this week. We look forward to having you back next week too, so we can dive into the conversation around portfolio construction, specifically leveraging the NASDAQ as part of a portfolio. We're going to be back again on Friday next week at 1 o'clock. We look forward to you joining us. And we also look forward to you taking the time and send us the questions, because again, it really helps drive the content for these webinars. And we really do appreciate you taking the time to join us today. Thank you. Have a great weekend ahead. Cheers.